Good morning, everyone. Thank you for joining us this morning and welcome to the update of our UK Residential Investment City Report. For those of you who went to this webinar and didn't attend the one we did earlier on this year, it was an overview of the top 10 investment cities in the residential market, kindly prepared by my colleague Ollie. And today we're also being joined by our Build for Rent specialist, Erica D'Souza. My name is Kevin Cofter. I'm an Associate Director in the International Properties Division, and the report came about as a result of a conversation with multiple clients in terms of where should they put their money if they're looking to invest in the residential market here in the UK. We booked you guys for an hour this morning. We can make that as long or as short as possible, depending on the questions that come in. We've already had a few, which we will address at the end of the session in the Q&A session. But please do put any questions in the chat box, which should appear very shortly. And without further ado, let me pass you over to my colleague Ollie, who will run through this morning's presentation.
Thanks, Kevin, and good morning, everyone. So my name is Oliver Kulitzajke. I'm a director in the research and forecasting team, and I'm the primary author of the research. And yeah, as Kevin said, the presentation will probably last for around 20 minutes, so there should be enough time for some questions and answers at the end of this. A quick overview of the agenda. So we're done with the introduction already. I'm going to provide a quick market update just on general trends in the residential market before I then talk about the research in a bit more detail. And then, as I said before, we're going to conclude with a Q&A session in the end. So in terms of residential market activity, obviously the residential market has been impacted by COVID, and there's a couple of charts here that show you exactly how this happened. On the left, you see monthly property transaction numbers, and you can see that since 2016, they averaged around 100,000. And the little spike there in 2016, that was the EU referendum, or well, before the EU referendum. But then they averaged around 100,000 per month, and you can see the large dip at the start of 2020, and that was the first lockdown. So that was March and April. Property transaction numbers fell quite significantly because the economy was shut down and you weren't actually able to transact or to do viewings or anything like that. And then afterwards, once the economy reopened, the government introduced the stamp duty holiday. Transaction numbers shot up. So you can see they reached a record high. You can see a few spikes there, a few spikes and a few troughs, and that's all caused by the multiple lockdowns that the UK has been in. So this is also impacted by the stamp duty holiday. So before the end of the stamp duty holiday, transaction numbers went up again because people tried to transact before the holiday came to an end, because it meant they could save up to £10,000–15,000 in some cases. And on the right, I'll show you mortgage approval numbers on a monthly basis as well. It's a pretty similar trend, driven by the same factors. You know, the economy was shut. You weren't able to actually get a mortgage approved. Everything took a lot longer, so mortgage approvals fell to a record low. They recovered pretty strongly, and even though they have slowed quite a bit since the peak late last year, they're still above levels that we've seen before the pandemic. Interesting also that mortgage rates, obviously it looks like they've moved quite a lot over the past 5 years, but by historical standards, I mean, they're very, very low still. You know, they're still well below 2%. They reached a record low a few months ago, and you can see they have moved up slightly since. Now, this was driven because people were expecting the Bank of England to raise interest rates. So the expected rise in interest rates led to an increase in the mortgage rates. Obviously, whether or not the Bank of England will do something next week is very uncertain, and I wouldn't want to predict that. House prices have held up reasonably well as well. I mean, they've generally been on a downward trend since 2014. But, you know, we've all seen it in the news that house prices surged recently. And there are obviously large regional differences. You know, in London, house prices haven't increased as fast as in other regions. There are multiple reasons for that. I'm not going to go into too much detail. But what I would like to say is that we do think that house prices will continue growing next year. Probably not at the same level, but there's still limited availability of suitable stock. and there's still a lot of demand for housing. You know, the reintroduction of the 95% LTV mortgages will lead to higher demand for housing. And generally, there are very few factors that are actually limiting house price growth. Now, in terms of the rental markets, rents have been pretty resilient to the pandemic, I'd say. So you can see the dark blue line here, which measures rental growth on an annual basis. And it's been fairly stable since 2016. I mean, it's come down a little bit, but it's generally been between 1 and 2.5%. Even during the pandemic, so in 2020, 2021, rents, you know, haven't fallen, and they were pretty stable as well. Now, the interesting bit here is the turquoise line, which shows you the RICS rental expectations index, and that actually reached a record high a couple of months ago. And this means that agents are expecting rents to increase further over the next 12 months. And it's illustrated as a net balance. So, for example, the peak there on the right of the chart shows that around 60% of agents believe that rents would increase over the next 12 months. So still a positive outlook for the rental market as well. And there are multiple reasons for that, which I can go into more detail at the Q&A session later. Now, my last slide, just a quick one on capital markets and investment volumes. So residential investment has only really been a case since 2015. And you can see there was a steady increase in annual investment volumes from around 1.5 billion in 2015 to a high of 6 billion last year. Now, at the moment, we're a little bit down on those levels, and part of that has to do with COVID. If you think of overseas investors, a lot of them still face travel restrictions or quarantine requirements when they return to their home country, and therefore overseas investment into residential has slowed quite a bit since last year. That's not just a case for the residential sector, that's a trend we see across all commercial property sectors. But we are quite confident that once travel restrictions are lifted again next year, that investment volumes will pick up again. Now, before I go into more detail about the actual report itself, I'd like to hand over to Erica, who will update you on the BTR market in a bit more detail.
Thanks, Ollie. I just wanted to echo some of the sentiments you've conveyed already. Build to rent is grabbing headlines, but is still a very small part of the market. In the past 24 months alone, existing build to rent investors have sought to expand their portfolios, whilst new entrants are looking to enter the market and diversify from commercial real estate. This sustained investor appetite will result in record-breaking levels of investment over the next few years. What's really driving investment is the granularity of the income from collecting rents and the scale of the opportunity in managing and operating multiple apartments and multiple apartment blocks or housing sites. The chart on your screens just captures data up to the end of October 2021. So we're confident that that's going to go higher by the end of the year. And it will definitely match, or if not cross, the 5 billion mark. But that's very encouraging for the residential sector in general. And on that note, I'm going to pass it back to you, Ollie. Thanks so much.
Thank you, Erica. Right, so without further ado, I'm just going to dive straight into the latest results. Now, for those of you who haven't been on the first webinar in May, so the research analyzes 20 cities across the UK, and we look at 20 different indicators. And the goal of the research was not to tell an investor exactly you should invest in this city or you shouldn't invest in this city. I think the idea was to highlight challenges and opportunities for each of the cities that we cover. And we split the indicators into those 4 different pillars here. Now, each of those pillars might be important for a different type of investor or for a different type of participant in the housing market. So, for example, the livability pillar includes a lot of indicators that draw people into a city. Now, obviously, if more people are drawn into the city, that will attract businesses. So there will be a higher need for housing. That's just one example. But generally speaking, each of those pillars has different cities in the top 3 or top 5. And the next slides will hopefully showcase some of this and also explain or highlight why we've done it this way. So the economics pillar includes 5 different indicators, and they're obviously all linked to economic performance of the city. So we look at GDP growth in the past, but also GDP forecasts. We look at the labor market, we look at earnings potentials, the general population and the catchment area of specific city, and then we also look at income inequality. And I show you 2 charts here. Now, the left one may look a little bit confusing, and you don't have to read all of the cities and all of the detail. I think the important bit here is that it illustrates GDP forecasts for each of the 20 cities. And the turquoise bars are the forecasts that we used when we published this report in May. And now you can see that all of the dark blue lines, the dark blue bars, are higher than the turquoise ones. And that just means that GDP forecasts have improved across all of the 20 cities. So that's a positive development. Obviously, there are regional differences. In some cities, the GDP forecasts are now even more encouraging. In others, the increase might not be as high. But the good story is that the economic forecasts have improved across all cities. And then on the right, I'll show you the ranking in the economics pillar. So Bristol places top, which means in terms of economic development, economic conditions, Bristol outperforms all of the other cities that we analyzed. Now, there's 2 main reasons for that. Number 1 is that the economic forecasts have improved to a greater extent than in the other cities. So that's why the dark blue bar for Bristol has a 2. That means it ranks 2nd in the GDP indicator. And Bristol has also very low levels of income inequality. Now, income inequality, is obviously still quite a big issue in London, but also in Edinburgh with a large financial center. And Bristol, on the other hand, has very low income inequality. Now, the areas where London and Edinburgh, for example, do well is the size of the economy, the population, the catchment area. Also, earnings potentials are a lot higher than in most other cities. So again, it just shows you that there are very different indicators that that different cities rely on and that cities do well in. Now, the R&D pillar is an interesting one because many people would probably expect Oxford and Cambridge to be well ahead of any other cities, but in fact, London actually tops this pillar. And part of the reason is, again, it's the size of London itself. It's the sheer size, which is just so much larger than any other city. It's very unique in Europe, maybe with the exception of France, where you have one very large area and then everything else seems very small. But you can see that Oxford and Cambridge obviously do very well in terms of their universities, in terms of access to an educated work pool. And they don't do as well in those indicators that are related to the size of the economy or the city. So in terms of the number of business startups, there's obviously less potential because the city is just a lot smaller. And also in terms of actual student numbers, those 2 are obviously quite small compared to London, which has, I think it's around 350,000 students. Obviously Manchester and Edinburgh student numbers are also a lot higher than in Oxford and Cambridge. But generally, the R&D pillar is taken by student cities. So if you have a good university, it means you have an educated workforce, and that will attract businesses to your city. Now, the livability pillar, it looks reasonably similar to the R&D pillar, with the exception of London. So Cambridge and Oxford, according to our research, are the most livable cities. And this is driven by a number of different factors. So life satisfaction is quite important in this pillar. We also looked at access to leisure facilities, such as gyms and swimming pools and tennis courts. We looked at the number of attractions. We looked at access to schools. So anything that makes a city livable, that draws people into the city, is included in this pillar. And yeah, I think it's probably reasonably unsurprising that the Cambridge and Oxford do pretty well. Now, Belfast, they actually topped the rankings last time around. They've now fallen into 3rd. There's one particular reason for that. So when we looked at the life satisfaction indicators from the ONS, there were actually only 2 cities where life satisfaction has improved, and those were Oxford and Cambridge. Whereas in all of the other cities, the perceived life satisfaction has declined, obviously driven by COVID and lockdown restrictions. But that's the main reason why Belfast is now in third and not in first anymore. Now, the last pillar we included is the property pillar, and that looks at different aspects of the housing market. So we look at house price growth, but we also look at affordability. We look at the share of renters in a city, and we take the view that a high share of renters is positive for investors. So that's why you see Belfast, for example, doing very well on that. There's a very high share of renters, and that's why they score 1 on that particular indicator. Now, the ranking here looks quite different to the pillars we've seen before. So you now have Belfast, Glasgow, Liverpool, Sheffield, and Leeds, whereas, for example, for the economic and R&D indicators, it were different cities. So I guess that this is just another illustration of the importance of looking at different indicators rather than focusing on just a single pillar or a single indicator to evaluate whether or not someone might be investing into a specific city. And again, I can explain all of this in more detail in the Q&A session at the end of this. Right, so those were the 4 pillars, and rather than showing you the whole 20 cities that we analyzed, I'm just going to show you the top 3. And hopefully that will be interesting for the audience. So London scores or ranks 3rd this time around. They improved by 1 place. So last time around they placed 4th. Now they're in 3rd. And if you look at this diagram here, it again might look quite complicated, but let me just quickly explain what it shows. So the diagram shows all of the 20 different indicators that we've analyzed and their ranking. And the darker the blue and the higher the bar, the better that city does in that specific indicator. Now, again, I don't want you to look at all of the 20 here, but you can see that most of those indicators in which London does well are on the right-hand side of the chart. And they are the economic and the R&D indicators. So things like GDP growth, earnings potential, student enrollment numbers, London does very well. However, on the livability and the property indicators, London has still some room for improvement. So, for example, access to schools, access to leisure businesses, and that's measured in per capita terms, is a lot lower than in most of the other cities. In terms of the property pillar, it's not a surprise that affordability is a big issue in London, similar to Edinburgh, for example. It's also not a surprise that house price growth has slowed in London. So we know all of this, and this chart just highlights this. However, there are also a couple of property pillar indicators in which London is doing pretty well. So the share of renters is obviously very high. Large population in London is still renting. It may be by choice, it may be driven by affordability issues, but regardless of that, it's still a very high share of renters. And we believe that this will continue going forward as well. Now, the Google Mobility Indicator, I haven't mentioned it yet, but that actually looks at how much time people spend at home. And the more time people spend at home, the more important it is that they have a nice home, we believe, right? So that's why we included this indicator as well, because it actually measures the desire to stay at home rather than, trying to leave home whenever I can. Second place this time is Cambridge. So Cambridge actually topped the rankings last time. And you can see that the diagram looks quite different. So for Cambridge, the bottom and right indicators are pretty positive. Again, they're not doing so well on the housing indicators, which is mainly driven by affordability issues as well. And the main reason why Cambridge has dropped into second from first are linked to the economic predictions now. So last time around, academic conditions were a lot more favorable than they are now. That doesn't mean that Cambridge will enter a recession, not at all. It just means that the forecasts are now not as positive as they were previously compared to the other cities, if that makes sense. Now, obviously, I showed you the chart of GDP forecasts, and they have improved in every city, including Cambridge, but they have improved to a greater extent in other cities. And that's basically the main reason why Cambridge is now in second, not in first anymore. Which leads me on to number 1. I don't know if anyone would have a guess. I mean, I can't hear it anyways. But So and Edinburgh tops the rankings this time. They moved up from second in our previous edition. And I think the interesting thing about Edinburgh is that they have very positive indicators in each of the 4 pillars, but also room for improvement in each of the 4 pillars. Again, if I go back to London, where we said strong performance across the R&D and economic indicators, room for improvement in the livability and property indicators. In Edinburgh, it's a very mixed story. So they have some pretty good indicators in each of those 4 pillars. Again, part of that is driven by its university, the qualification of the workforce, but they also have seen pretty strong house price growth. They have a large number of attractions. There's good access to leisure facilities. Life satisfaction is high. It's a large population, a large catchment area. So plenty of reasons why Cambridge is a good destination for investors, for businesses, for people to live in. And I hope that those charts make sense to everyone. Again, I can explain them in a lot more detail in the Q&A session. Yeah, so that's me done with the overview in general. I don't want to go into too much detail just because I know that, it's we've already spoken for what, 30 minutes, and people have things to do. Time is precious. But I'm going to hand you over back to Kevin now for the Q&A session. And yeah, please feel free to use the chat function to ask anything that might come up.
Thanks, Ollie. Thanks, Erica. Thanks, everyone, for staying online. We have had a couple of questions come through, so I'll aggregate them to make it a bit easier. Ollie, if I can start with you first, if you don't mind. Ollie, what are the macro and micro views on Liverpool residential market?
Yeah, so that's a very specific question. Obviously, we have a lot of details on each of the cities, which we can definitely pass on to anyone who's interested. But I mean, Liverpool in general has seen pretty strong house price growth, for example, compared to some of the other cities. And I think there were only a few cities in our analysis where house price growth was actually stronger. I think Edinburgh, Manchester, maybe Glasgow. So again, that's one of the positives. It's also a lot more affordable than other cities. So obviously incomes are lower than in the likes of London and Edinburgh, but house prices and rents are also a lot lower. So it makes Liverpool a lot more affordable than the larger cities. And in terms of the economic predictions, Liverpool does pretty well as well. I think unemployment is below the UK average. GDP is still expected to increase. There's still going to be population growth going forward, which means higher demand for housing. So I think the picture for Liverpool is pretty positive, and I hope that answers the question.
Sorry. What is the new evidence stroke stats for proof of migration back to the cities post-COVID?
Yeah, so there's very limited statistical evidence, if you like. So the ONS, they release mid-year population estimates and migration estimates, but the latest data only covers the period up to mid-2020. What we have seen, as you would expect, in the year to June, that there was quite a big shift out of city centres. So the likes of Birmingham and London, Manchester, Leicester, they've all seen a net outward migration. So people were leaving the city, and areas like Cornwall and Bedfordshire, they've seen increased population numbers. So people migrated to those areas. Now I think it's reversing again, and that's just me speculating, because the ONS obviously they haven't published their figures yet. But if you speak to agents or to generally just amongst your friends, there are a lot of people who thought they would move out of the city and never come back, but now they actually miss the city, if that makes sense. Working from home is one thing, and some people enjoy it, some people don't. But I think once the economy reopens fully, that people want to be close to the city. So I think there will probably be some form of reversal going forward. I don't know to what extent and which areas will be mostly affected. But yeah, I mean, the evidence is pretty limited at the moment.
Okay, thanks, Ollie. This was bound to come up. Unfortunately, it's a very hot topic, as we're all aware. Do you think the Omicron variant or similar will have an impact on future property investment decision-making here in the UK?
Yeah, that's a good one. I mean, I think there are different factors or different channels through which Omicron or any other future variant will impact on residential market activity. I think if we think about investors, the main issue with those variants are travel restrictions and the need to quarantine when you return to your home country. And that's definitely something we've seen this year across most of the commercial property market segments. So because, you know, if you're a foreign investor and you don't have a UK-based team and you want to invest hundreds of millions of pounds into buildings or development sites, you probably want to see it, right? You want to physically inspect maybe a building, you want to see a development site. And that's definitely still an issue that we have, and that could deter future investment from overseas as well. And I think on the investment slide, it said that so far this year, we've seen 1.1 billion pounds worth of investment from overseas into residential, and that figure was 1.5 billion last year. So you can see there's still a bit of a difference. And I think that could definitely be a bit of a headwind going forward. Now, what I would say also is, though, that because of Omicron, the Bank of England might now not raise interest rates in December, maybe even not in January. I mean, no one knows, I'm not going to predict this. But if the bank rate stays low, it also means that mortgage rates will remain low. So that could lead to higher housing market activity, could then lead to higher house prices again, and therefore have a bit of an inverse effect, if you like. But yeah, I mean, very good question, very hard to predict, but I think it would all be linked to travel restrictions.
Okay, thanks, Ollie. Erica, just to bring you into the conversation, we've had a couple of questions for you as well. What are the typical things a build-to-rent investor would look for in a site acquisition? And I might actually double up on this question because we have had a flurry come in. By institutional investors, are we referring to pension funds, sovereign wealth, etc.? So 2 parts. What are the typical things a build-to-rent investor looks for in a site acquisition? And secondly, who are they? Who are these people?
Thanks, Kev. Those are great questions. For your first part, what do the institutions want? I would say they want to operate an asset on a long-term basis in the right location. So if your site is within the city centre, close to a train station, next to a beautiful park, you want to focus that for build to rent, because the institutions are keen to deliver not just a home, but build a community and really add to the location and build on that neighborhood, because you want to drive engagement as much as possible, not just within the building, but with your neighborhood as well. We're not keen on building isolated new developments. So that's number one. Number 2 is scale, because you're going to be operating these on a long-term basis. I'm talking 10, 20, 30-year hold periods. So you want to have operational efficiencies in managing the residents, giving them the best service possible, and just taking care of them and taking care of the asset on the long term. So I would say a minimum of 75 apartments in an unbroken block is ideal, and then it just goes upwards from there. We're dealing with investors looking for 500 apartments, if not more, in just a separate part of a wider master plan maybe, and sometimes in single blocks as well. So it's getting very interesting on the scale aspect. And the third one I would say is efficient layouts, because you're going to be offering a service to the residents. You want to think about amenity spaces where they can mingle and engage with their neighbors and make friends, and grow their network internally within the building. You want to think of front of house amenities and back of house management spaces where they can house their staff, offices, leasing facility, marketing suites, those sort of aspects. So it's almost like a hotel, but it's tailored for rental occupiers. And then the last one I would say is, how much can you future-proof your development? With the changing regulations on sustainability, elevation materials, it's a major concern going forward, because if the investor is looking to commit capital day one, when you've broken ground, or maybe even before that, they're committing to operating the asset for the next 10, 20 years. So this becomes a major concern. It comes down to the materials, EPC ratings, and it's a moving target. So nothing's 100%, but it's definitely something that has to be addressed as much as possible sooner in the development timeline. So I would say those are your 4 key aspects that any institution would hone in on before considering an investment into build to rent. And for the second part, who are these people? I would say it's capital coming in from more mature markets like the States, Canada, and then there's on the other side, and Europe, and on the other side you have sovereign wealth funds, family offices looking to enter the UK market because it's a great place to invest. I would say that's the Middle East and then Asian capital, very much so. And then obviously you have private equity houses that operate across the globe. But because renting or institutional renting is so much of a new market for them, they're bringing in a lot of their lessons learned from more mature markets into the UK, and it's becoming more of a focus. So it's sovereign wealth funds, pension funds, family offices, and private equity houses around the world. I hope that answers your question.
Super, thanks, Erica. A couple more questions have come in. I'm surprised to see London so low on attractions. Can you zoom in on to why this came out so low? That's probably for Ollie.
Yeah, again, so that's just driven by per capita calculations. So obviously, you know, if you think about London, you go into the city, there's so many attractions that people like to visit. But I think smaller cities have a slight advantage here because, you know, if you look at Cambridge and Oxford, they're a lot more compact. And yeah, in terms of per capita attractions, those cities generally perform a bit better than the larger cities. So yeah, it's just a scaling thing.
Okay, thanks, Ollie. Another one for you, as I've got you. How do you select the 20 cities that you analyse? This attendee has noticed that Luton was included, for example, over some of the arguably larger cities. So how do you go about picking these 20, Ollie?
Yeah, that's a very good question. So we looked at obviously the largest cities in the UK, that's number one, but then we also looked at which cities are important for residential. So it was not just an arbitrary choice. There's some thinking behind it. And yeah, I mean, you probably haven't seen all of the 20 cities because I don't think we've shown a list here. So obviously some cities you haven't seen in any of the slides, but they're still included. I don't even have an example. But yeah, I mean, you know, we included all of the larger ones, obviously London, Birmingham, Leeds, Manchester, Belfast, but then also a few smaller ones that are important for residential in more general.
Thanks, Ollie. Okay, this one I guess is for both of you. Do you have a ranking of the cities based on a share of build-to-rent investments?
Interesting. I would say this existing report is us taking a stab at looking at what are the top cities to invest in. If you want to diversify from that and really make it a more bespoke report, we're happy to consider it. It's a very interesting proposition to look at just build-to-rent investments and which cities perform well or how they rank. But Ollie, do you fancy doing a similar build-to-rent report?
Definitely, yeah, that'd be an interesting one. I mean, yeah, as Erica said, I think a lot of the factors and indicators would still apply if we tailored this towards BTR. Now, there would probably be some other indicators that would be included as well. And yeah, I mean, it would be an interesting exercise, and I don't know how much the rankings would change. But yeah, if you wanna send us a message or email after this, then we can definitely get in touch.
Thanks, guys. Okay, a couple more quick questions have come in. I think we're approaching the end now, so I'll keep it brief. Great presentation, guys. When are you looking to do the report, presumably in Q1 or Q2 of next year?
So the idea at the moment is to do it biannually, which means the next one will probably be around June time, I'd say.
Okay, thank you. This person's still typing. Okay, no, deleted. Right. It looks like we've pretty much wrapped up the presentation for this morning. So I'd like to take the opportunity on behalf of myself and obviously Ollie and Erica to thank all of you who've attended today. I believe that the actual report will be released in due course at some point after the presentation to those of you who've attended. But from myself, please let us know any feedback, or if there's anything you may want to see in the report next year. By the sounds of it, Build to Rent might be included. We'll have to wait and see. But on that note, I will bid you all a farewell, and if we don't speak beforehand, have a good Christmas break. Thank you.
Thanks, everyone.